Hello, everyone. Welcome back for another installment of our ongoing series of Lunch and Learn webinars presented to you here by Zacks Professional Services. My name is Mayur Thaker. I am an equity strategist here at Zacks, and today I want to give you another update on where things stand from a macro standpoint. And if you've been following me here, I've been, kind of consistent with the same theme all year last year. And although the market, posted an incredible year last year, up 26%, that was a blazing hot year. I continue to stick by this idea that we are very steadily descending into recession. And I know that that's becoming less and less, believable because of how strong the equity market has been. But remember, stocks can remain strong right up until the very beginning of recessions. So I just wanted to keep that in mind. Remember, we were in recession by December of 2007, and it didn't take, another 6 months or so before people really realized that something is terribly wrong. Even with the demise of Bear Stearns in the spring of 2008, people still kind of brushed that aside, thinking that the worst was behind us, and in fact, the worst was in fact ahead of us, at that point in time. So the point here is that, in terms of the indicators that I track that I believe are incredibly important, these indicators cannot be ignored, and they continue to move in the wrong direction. And this is very atypical for periods of economic expansion. So again, even though the market has been very strong, you cannot have a bull market in terms of the economy without the assistance of these key categories, which I'm about to share with you right now. So these are the categories that I'm watching, and this is why I believe we are still entering recession, again, despite the strength in the equity market. Manufacturing, the inverted yield curve, the leading economic index, excess savings, cyclical GDP, employment, and credit. These are the broad categories that I'm watching, and these are all moving in the wrong direction. Again, these are simultaneously in areas that are typically consistent with recession. And again, unlike past market environments, this could be the most important. The Fed is not supportive of stocks right now or bonds, and won't be until we see a sizable decline. So people that are expecting rate cuts, as much as 7 or 8 rate cuts this year, which is what the bond market was pricing in not too long ago, which ignited the equity rally. I think that's a pipe dream, that we're not going to get that many cuts this year. And if we do, it will be for the wrong reasons. Again, because I believe that these underlying economic trends are pointing towards recession. So that is the key there. Sometimes rate cuts are not necessarily bullish. In fact, they can be very bearish. So let's take a look at each of these here. Again, I think that one of the main reasons why we're seeing softness is because real yields, not necessarily nominal rates, which is what the Fed determines, but on a real basis. This is taking the 10-year nominal yield minus the 10-year inflation expectations that are priced into the TIPS market. And if we look at that, these yields in real terms briefly hit 2.1% not too long ago. It has since backed off to about 1.7% right now. But again, that's, we're at the highest levels in 20 years. So at the margin, when the cost of capital rises relative to where we were, not just, just a few years ago, when you see incremental increases in the cost of capital, there is a lagged but very pronounced effect on economic decision-making, both by consumers and by managements. Because remember, as we see the hurdle rate increase, that means that it's becoming more and more challenging for equity, for asset managers or for corporate managers to deploy capital in an attractive way that earns additional returns on capital. Meaning, if the rate that we use as the benchmark rate has increased, that means that, companies that are at the borderline that earned returns on capital of, let's say, 1 or 2% or 3%, suddenly those CapEx projects are not very attractive anymore. And so it makes more sense for, corporate managers to then return capital to shareholders rather than deploy it, because they're not earning significant enough returns on capital to cover that benchmark hurdle rate. And even if they are covering it, it's now to a lower degree than it was just a few years ago. So the additional value added has therefore shrunk. That hits multiples, or at least it should hit multiples, but even more importantly, it should hit decisions made by managements. And what we will inevitably see here is a reduction in CapEx spend. And that's exactly what we have started to see in the second half of 2023, and I think that's going to accelerate in 2024. So these are not bullish trends. We can see that manifest in manufacturing. ISM manufacturing PMI, this is probably the most important manufacturing production gauge. This has been in contraction now for 13 consecutive months. And as you can see, this has a very strong positive correlation to forward earnings estimates for the S&P 500. And as you can see here at the very tail end of that, I want to just draw your attention to the current moment. We're still seeing very, very bullish earnings expectations for 2024 without the assistance of ISM manufacturing. And that has never really held up in the past. Every time you've seen weakness in manufacturing, you've also seen weakness in earnings expectations. And right now, we're seeing a very curious divergence between earnings expectations and manufacturing activity. I believe that will converge back together. Unless if we see a very strong rebound in manufacturing in January and February, we will see earnings estimates decline. Because that just simply has never been the case. Manufacturing, even though it's only about 10 to 12% of US GDP, the size of manufacturing is not as important as the implication in directional terms. So as manufacturing contracts, so does S&P 500 earnings, despite the fact that services dominate most of S&P earnings rather than manufacturing. They still share a very, very strong correlation. And that's because manufacturing, the US still manufactures many big ticket items like autos and aerospace and things like that, as well as, both high-end chips as well as low-end chips, such as, that produced by Texas Instruments, as well as PC chip manufacturing, such as RAM and, hard drives and such things like that. Even though those are very small relative to GDP, these things do move up and down with S&P earnings, as you can see here throughout these last, 25 years. But even, in the most recent past here within the last 5 or 6 years. So again, I believe that unless if we see a rebound in ISM manufacturing, I really believe that we're going to see earnings estimates come down, as they always do, basically every year. Analysts begin very, very bullish, and as we go, through the year, those estimates are marked down. And I believe this time is going to be, especially important because, we saw no growth in earnings last year. And so if we see another year of no growth in earnings, remember, the market is not priced for another year of no growth. We had 2023 with no growth in earnings, and 2024, analysts are expecting an explosion of 12 to 13% earnings growth. If that doesn't materialize, then this equity market rally is at risk, in my view. Here's another proxy for demand, ISM manufacturing new orders. This is another leading indicator. This is at, levels that is consistent with recession. It's been 18 consecutive monthly declines. So remember, the longer this remains in contraction, the greater the probability that we actually enter recession. Right now, the market believes that whatever weakness that we're seeing in the economy is, essentially just a soft landing. It's just a softening. But the longer this remains in contraction, either ISM, manufacturing, ISM new orders, or any of these other gauges that we're talking about here today, the longer it remains in contraction, the greater the probability that it's not just a soft landing, it's not just a softening, but it's actually descending into recession, where, these figures end up coming in below long-term trend, which is what recessions are. So the longer this remains in recession, the greater the probability that we are, the longer this remains in contraction, I should say, the greater the probability that this is not just a softening, but a recession. The Philly Fed Manufacturing Index, this is more of a regional manufacturing gauge. This has, been in contraction as well for quite some time. Basically in line with what the ISM manufacturing is stating. And anytime this has had a reading below -25, we've had a confirmed recession with no false positives. And that's, we got that, registered, last year. And this is implying? Factories are therefore cutting work week hours. The work week is now down to about 40 hours, 40.7 hours. It's actually closer to 40 now. I should have, I believe this is as of November. But with the latest reading in December, this is now down to about 40.1. And that means that we're, basically down in this level right here, which is consistent with where we were in 2008. So again, if manufacturing is strong, if the economy is strong, then we should not be seeing factories tapering the work week as we are seeing here right now. The inverted yield curve, this is a time-tested, forward-looking indicator for recession. I believe this time is no different. If we look at the spread between the 2-year and the 10-year yield, this is very consistent with the recession. We've been in deep inversion now for, since, I believe, in the middle of 2022. Mid-2022, we've been in inversion. Typically, what happens historically is, as you can see here, we enter inversion somewhere between 12 to 24 months before the official start of the recession. So as you can see here, we entered inversion in 2006, and the recession was not declared until early 2007, or early 2008, I should say, maybe late 2007. So that was a year and a half in advance of notice. And here we're entering or approaching almost 2 years. That's about a 24-month lead time that we have been given. This is basically consistent with where, how early the yield curve typically forecasts recession. So we're entering that critical time period now. And as you can see, directly before the recession begins, you see a rapid re-steepening of the yield curve. When that re-steepening happens, that's when it's game time, in my view. As you can see here in the last 3 recessions, even 4 recessions, if you go back even to the mid or late 70s, early 80s, you saw the deep inversion followed by a re-steepening right before the recession started. I believe we're starting to see that now. If you zoom into this here, we are now at a minus 26 basis points inversion. So that is a rapid steepening from where we were in mid 2023, just mid last year, where we're at a minus 100 basis points inversion. So I believe that this number is actually starting to creep up. If we see, a re-steepening above 0, that typically, again, as you can see here in the historical chart, that's typically when recessions really get going. And sometimes, remember, recessions don't get declared at the start. The NBER, right, the National Bureau of Economic Research, oftentimes they can declare recession in arrears. So it could be until, November or December where that committee says, hey, we've actually been in recession since June, for example. So they could actually declare the recession in arrears, as was the case in 2008. So I believe that early signs of recession starting is now starting to manifest. And that will especially be confirmed if we see this number exceed 0. And I believe that's going to happen in the coming months. History has shown that forced inversion breaks things. The Fed has taken the Fed funds rate well above the 2-year yield even, to an extent that we haven't seen since 2007, 2008. Forced inversions end up really, hitting the brakes on economic expansion, and that's what we're seeing here. The Conference Board leading economic index has now been in decline for 21 consecutive months. We just got an update for December this week, and it was once again in contraction. That's now 21 consecutive months. This is now firmly at recessionary levels. It's led by weakening credit growth and manufacturing new orders. We just saw that manufacturing new orders chart. So again, the economic index of about 10 or so different leading indicators continue to forecast recession. These are things that we can't ignore, folks. We do not see periods of economic expansion without the assistance of manufacturing, without the assistance of credit. And here, now we're going to get into the crux of the matter, which is retail sales. Retail sales are a massive part of the U.S. economy and GDP. And the bulls will tell you, and they are very correct in pointing this out, which is that real retail sales are bouncing back strong after a brief contraction. I was talking about this mid last year where it fell below 0, entering contraction, which is, again, very consistent with a recession. But that number has now bounced back with a vengeance and up 2.2%. This is real retail sales adjusted for inflation. So that's a very, very strong print. This is through December of 2023. So the year-over-year growth rate in December was very, very strong on a real, meaning inflation-adjusted basis. However, the reason why I think that this real retail sales, or retail sales in general, is at risk is because of this chart right here, where the reason why retail sales have been strong is because consumers have chosen to spend at a rate that exceeds their personal income. So spending has outpaced income growth for the last 2.5 years, which is why we have seen a significant drawdown in excess savings. We saw during the post-pandemic period, Americans amass record levels of excess savings well above trend. But now they've drawn down those excess savings through spending, and we're now well below the pre-pandemic trend in excess savings. And these excess savings are now expected to be exhausted, by the first half of this year. As you can see the trend here. So if this pace continues, which it looks like it has, because again, we saw a very strong print in December for retail sales, wages have not, rebounded that much, which means that, again, Americans have spent more than they have earned, which means that, again, I expect this number to continue to contract and basically be exhausted by the first half of this year. And here we see an update to this number. This is published by the BEA, the Bureau of Economic Analysis. So this is as of September. Excess savings were at 0.4 trillion, so about 400 billion as of September. And now as of November, from 400 billion to now 290 billion. So again, excess savings, is not a sustainable source of funding for spending. Ultimately, consumption has to downsize, has to right size to incomes. You cannot perpetually spend more than you earn. The laws of economics just simply say that that's not possible unless if you have excess savings. And that's exactly what has happened. So the pace of retail sales that we're seeing here, in my view, are not going to be sustainable for much longer. I think this may continue for the first half of 2024. So maybe the first 5 months, maybe 6 months of 2024 will show strong retail sales again, but as these numbers approach exhaustion, we will start to see retail sales decline. So I'm just using first principles thinking. The only way that consumers can spend at these rates is if you have excess savings or if you have access to credit. And as we see here, excess savings are being drawn down, soon to be expired by the first half of this year. And then we'll look at the credit side of the equation as well. But even credit is starting to contract, as we see in objective data published by banks. And we'll get to that a little bit later in the presentation. But here, now we look at GDP. And GDP has been very strong. But if you look at the subcomponents of GDP that are more cyclical in nature, meaning durable goods orders from the PCE side of things, as well as residential investment and business equipment investment, these are the cyclical components of GDP that are actually susceptible to the business cycle. And here you can see that those three components of GDP are now in recession. And this never happens outside of recessions. As you can see here, cyclical GDP, meaning those three categories, are always in expansion during bull markets. And they only enter contraction immediately ahead of recessions. As you can see here, during the early 80s that happened, during that 1974 recession that happened, during 2007, 2008 that happened. It happened again briefly during COVID, and now it's happening again. These three components of GDP are not to be ignored, again, because of the value that it provides, as you can see here, as a leading indicator to aggregate GDP. So while aggregate real GDP is good, remember that number can be obfuscated. It can be distorted by government spending. It can be distorted by education and healthcare. These three sectors are very large sectors of the economy that are not cyclical, meaning they operate on their own terms. They're not susceptible to recessions. And so using GDP to forecast where we are in the business cycle can be very, very problematic because of these anti-cyclical components of GDP. So we have to isolate the cyclical components to actually see where we are in the business cycle more clearly. And as you can see that this number never enters contraction outside of recession, and that's where we are today. So that cyclical GDP is now below trend. Many people will say, well, that's just simply happening because it's normalizing for, this very, very strong print that we saw in 2021, post-pandemic. But that's not the case. If you look at it from a dollar standpoint, it's actually indexed to 100. So if you look at it in an absolute, basis, we're now below trend. So it's not above trend, returning to trend. We were above trend in 2021, but we're now below trend as of right now, while GDP is at trend. So this is telling us that GDP, again, is being distorted by non-cyclical components, government, education, and healthcare. If you look at the core components that are actually susceptible to business cycle volatility, that's now, below trend. That's very, very important. We cannot ignore that. Another thing that's also concerning is while GDP is strong, gross domestic income is either flat to negative. That never happens outside of recessions. As you can see here, GDI, which looks at incomes, right, corporate profits, it should be theoretically the same. In normal times, they are the same. As you can see here, most of the time, GDI and GDP move in unison with one another. Most of the time, they confirm each other. But it's only during recessions when that ratio, that relationship breaks down. As you can see during 2008, during COVID, during this recession in 1991, that number fell below 1. Typically, this number is at or above 1. But right now, that relationship is breaking down. Again, that typically only happens during recessions. The GDP Plus, which is an enhanced index of GDP that's published by the Philly Fed, that's not in contraction, or it's not zero like GDI is, but it's very, very much more tame compared to what we see in GDP. So while GDP was very strong in Q3, we're going to get an update in terms of Q4 this week. But Q3 GDP was a blazing hot 4.7%. But the enhanced index, which looks at more, corrects for some of the discrepancies or other, aspects of GDP that, are distortionary. And that number is only 1.7%. So economic growth is a lot more tepid than what it appears in the headline number, both by GDI and by GDP plus that the Philly Fed publishes. Let's look at employment. So while headline job growth has been strong, just like what we did for GDP, cyclical undercurrents are weakening very quickly. So here we can see a chart of aggregate payroll growth versus cyclical payroll growth. The orange is the cyclical components, and the blue is the aggregate. So remember, aggregate payrolls really enter contraction during the thick of recessions. You never see job cuts ahead of recessions. You always see them while the recessions are already underway. So what I did here is I went through every one of the 40 plus industries that the Bureau of Labor Statistics reports every month when they publish the jobs report, and identified 11 or so industries that are truly cyclical in nature, meaning that they're not, secular trends such as government, education, and healthcare. They are truly cyclical in nature, meaning they actually rise and fall with the business cycle. And what this does is that it gives you a lead time, just like what cyclical GDP did. It gives us a fair warning ahead of recessions getting started. As you can see, it gives you about a 3 to 6 month lead time before the headline number starts to fall into contraction. And here we see that number has not yet fallen into contraction, but it's moving in that direction very, very carefully and steadily. And the crossover is also very important as well. When this number actually crosses below the headline number, that's the first warning sign. And then when this actually enters contraction, again, this never enters contraction outside of recessions, as you can see over the last 40 years or 30 years. So if this number enters contraction, which I believe it will, that's going to be the ultimate leading indicator for a recession. I believe that this number will enter contraction in the first half of this year. So I'll keep you updated on that. Although it's not happened just yet, the trend is very clear. And if you add up the other sort of areas of the economy experiencing weakness, such as manufacturing, I think it's very clear that number will enter contraction. So cyclical employment, again, it measures the total labor force working in sectors outside of these three areas. Again, the reason for doing that is because these three areas are not cyclical. They're not affected by recessions. So why would we look at that if we are trying to forecast recession? So it gives you a much greater analytical relevance by removing those three sectors and looking at the other sectors. The other sectors that I include in my cyclical index are things like plastics manufacturing, trucking, garden and home, sort of improvement stores like Home Depot and Lowe's. We look at those types of sectors. We look at professional services. We look at banking jobs. We look at manufacturing jobs, things like that. Those are the sectors that go into the cyclical employment index because those are the industries that shed jobs first ahead of recession starting, because their industries begin to get affected by slowing demand first before it starts hitting other sectors. And so these industries have a pulse on where we are in the business cycle ahead of time, both in the recession and in the post-recessionary recovery. As you can see, it actually enters expansion ahead of the headline number. So this is relevant both during entering recession as well as exiting recessions. So it's very important to look at this. So if this enters into contraction, that's going to be the ultimate confirmation, because up till now, the job market has been blazing hot. It's been very strong, but you can see that there is weakness starting to build within these sectors and industries that are very, very analytically relevant. So temporary help services is one example of a cyclical leading employment indicator. This is a part of the overall cyclical employment index that I have here on this chart. This is one component of that. Temporary help services. This is when companies hire full time, but for a contractual basis, meaning 1 month or 3 month or 6 month or even 1 year temp hire. And this is now in contraction. This does not happen outside recessions. Temp help services are typically in expansion during bull markets like we saw basically throughout 2010 to 2020. But it's now in contraction. As you see here, it happened in 2007. It happened in 2000 and in other prior recessions as well, like in 1991. And here we are again. Again, these are things that don't typically happen outside recessions or just ahead of recessions. Here we see the permanent job losers. This is, again, another number reported on the monthly jobs report. This number has actually since ticked down below the 2-year moving average. But as you can see here, any crossover above the 2-year moving average is typically confirmation that we're about to see a significant rise in the number of job losers. Now, it crossed over as of November, but then it crossed back below as of December. However, I think that the trend is very clear. These are very, very close numbers. It's not, a big change month over month. But, I think that the trend is very clear that this number is headed upward. And as long as areas such as manufacturing, cyclical industries that go into the employment index, as long as these areas remain weak, as long as new orders and backlog remains very weak, as long as the work week continues to get cut, you're going to see a rise in job cuts and therefore these job losers category. So we'll see if that continues. Now, jobless claims have been very, very low, extremely low. But you are starting to see that pick up. Again, well off, historic lows here, but that number is starting to rise. So I believe that's going to follow what we see in permanent job losers. Now, analysts are very bullish on earnings this year. But again, I believe that the leading indicators of earnings, such as ISM manufacturing, even ISM services, suggest that these expectations are vastly overstated. Here, let's look at what I'm looking at in terms of charts here. If we look at in ZRS, the fiscal year earnings expectation revision, here is a look at the S&P 500, stock price chart. As we saw here, we saw a substantial breakout. But look at the estimate revisions for each year. We started 2020 with vastly marked down estimates. We saw, 2021, getting marked down as well. 2022 was marked down, in 2023, this blue line right here was marked down throughout the entire year. But 2024, the benchmark is very high. As you can see here, it's been relatively consistent. Analysts have not revised estimates down significantly. But look at the deviation, the delta between the ending number here and the current number here. Analysts are expecting a significant turnaround in earnings. As you saw here, last year we ended up basically negative versus ending 2022. So we had slightly negative earnings growth in 2023. But analysts are expecting a flip to switch this year, where earnings rebound significantly by 13% almost year over year. Now, Q4 estimates were marked down year over year from plus 5.5% to now 0. So as we enter the Q4 earnings season, expectations have been wildly marked down from 5.5% growth year over year to 0 growth year over year. So I don't understand, or I don't know what analysts are thinking in terms of just magically switching back into growth this year, especially as, credit remains in contraction and manufacturing remains in contraction and cyclical industries continue to cut jobs. I'm not sure exactly where that growth is going to come from. Perhaps it's from technology. But again, analysts are very, very bullish on earnings this year. And if the leading indicators of earnings are correct, then these numbers are going to be marked down significantly. I think it started to happen now, but we're going to see in the next couple of weeks as companies report earnings and analysts digest what was reported, I think this number is going to come down significantly over the next couple of weeks here. So again, recessions are always a very slow buildup of many things. I know I've been talking about this for over a year now, but this is a process and it never happens all of a sudden. You see these leading indicators start to enter contraction very early on, and then you see the coincident indicators all of a sudden turn around. And that's, I think, what's going to happen as long as these indicators remain in contraction for a long time. Banks continue to face a lot of difficulty. You're seeing credit availability tighten. You're seeing very large unrealized losses on their held-to-maturity securities. You're seeing significant cracks in commercial real estate. All of this is leading to loan loss provisions rising. This is, by the way, prompting a research paper published by the NBER that states that 14% of all loans and 44% of all office loans are in negative equity now, which means that the outstanding loan balance is greater than the market value of the properties that they are, held against. So they're underwater. These loans are underwater right now. This could lead to up to 300 regional banks at risk of solvency runs. If the default rate on these pick up, or if regional banks, are forced to assume ownership of this, they're at risk of solvency. And this is according to the NBR. You can see the research right here. This is the paper that they published in December of 2023. This is very, very substantial what they're saying here. I'm just going to take a quick look at what they said. Using loan level data, we find that after recent declines in property values following higher interest rates and adoption of hybrid working patterns, about 14% of all loans and 44% of office loans appear to be in negative equity, where their current property values are less than the outstanding loan balances. So again, this is, I think that this should not be ignored at all. If you look at the conclusion, our analysis reflecting market conditions up to Q3 of 2023 reveals that CRE distress can induce anywhere from dozens to over 300, mainly smaller regional banks, joining the ranks of banks at risk of solvency runs. So this is a very, very notable paper that we need to be paying attention to. And on top of that, right, we see, banks getting hit with withdrawals, again, because interest rates are much higher today than they were a year and a half ago. And so people are fleeing bank deposits in favor of money market mutual funds. So all this is prompting, rising loan loss provisions, again, because of CRE exposure, but also because of rising delinquencies. The net result here is tightening credit availability. So banks are tightening credit at the fastest rate that we typically only see in and around recessions. Bank lending rarely contracts, again, outside recessions. You never see banks taper credit outside recessions. And delinquencies are rising. You can see that, credit card delinquencies here across all commercial banks are at 3%. 3% may not seem high, but that is now a 10 plus year high, going all the way back to 2011, 2012, as we were exiting the great financial crisis. So again, at the margin, when you see this number rising, this is bearish for bank earnings. And if bank earnings are negative, or if bank earnings are under pressure, you're going to see lending also come under pressure. And when lending comes under pressure, S&P 500 earnings come under pressure. We can't have earnings growth without lending growth. It's just not possible with the way our economy is structured. So when bank lending contracts, I believe earnings across the S&P will contract. And here you can see deep cuts to bank earnings forecasts. And this is not turning around, folks. So we're not out of the woods yet on the issues that banks and insurers are facing. Now, Discover, the credit card company, they just reported Q4 earnings just a few days ago. Their shares declined by 10% on that earnings announcement after they reported that credit loss provisions more than doubled from $900 million a year ago to $1.9 billion as of Q4. And that was because of sharply rising delinquencies. This is very important and noteworthy because Discover is a bellwether of the health of the American middle class, because they have over 60 million cardholders, mostly of middle incomes. So you're starting to see that corroborate, by these credit card companies and other banks that have direct exposure to either commercial real estate or, consumer loans. So regional banks are dealing with all these fires simultaneously. I don't think we're out of this, we're just not out of the woods yet with regards to this. Manufacturing backlog remains in contraction for 15 consecutive months. Again, that typically only happens in and around recessions. The Fed continues to pull liquidity by normalizing M2. Again, that puts pressure on liquidity, again, which puts pressure on everything across the economy, including retail sales. New home prices are collapsing again on rising, financing costs. New home sales, the median sales price of a new home has now collapsed by over 16% year over year. Again, that's by design. The Fed wants to see this happen because their goal is to put inflation under control. So what does this mean for equities? We're at almost a 20 PE right now, which is way higher than previous 5% interest rate environments. And right now, we have growth expectations, but those growth expectations, I believe, are going to be proven to be vastly overstated because of all of these underlying trends that we see here that puts significant headwinds to earnings growth. And now we see that the one-year treasury yield is far above the S&P free cash flow yield by the largest margin since 2007. So right now there are options out there apart from stocks. After a banner year last year, equities are not exactly valuable relative to a zero risk investment such as 1-year US Treasury yields. So FedEx is reporting declining shipping volumes. We see Maersk also issue profit warnings basically throughout 2023. This is the largest shipping company in the world. They've been talking about recession now for some time. American Express is reporting rising loan loss provisions, just like Discover is. And this is surprising because American Express doesn't even take on a lot of credit risk. And yet even they are seeing rising delinquencies, which is why they're reporting increasing total bad debt provisions. So again, I believe that the market is significantly overvalued. I've been saying this for a long time. I've been wrong on that call. I fully admit that. The market posted a massive year. But one of the caveats to that is that 30% of the index is now just the big seven, the magnificent seven as they call it. If you look at the equal weighted index of the S&P, that was up about 10 to 12% last year. I believe it, I think it was around 12 to 13% in 2023, which is still a strong year, but nowhere close to what the index is reporting at 26%, primarily because the index is being carried by about 7 companies last year. Those are the mega cap tech companies. There isn't a whole lot of breadth being placed in terms of these returns from small caps and from other cyclical industries such as banks, transportation stocks, and others like that. And here you can see that the Shiller PE suggests that the next 5 years could be very lackluster in terms of total returns based on where we are in the earnings yield of the market. So again, my primary conclusions are the same. The direction of leading fundamental indicators, credit, manufacturing, the inverted yield curve, excess savings and the trend in excess savings. These are all headwinds, in my view, that will put negative pressure to S&P earnings growth. This means that analysts will mark down. They've already marked down 2023, but they will mark down 2024 earnings forecasts. I think the moment of truth is here. We're going to start to see that in the next couple of weeks. Markets, however, are priced for earnings growth, very robust earnings growth at a forward PE of almost 20 times. So that's the base case. Right now, the base case, the implied valuations, to me, communicate that the market expects a soft landing where inflation successfully lands at 2% without the economy tilting into recession. And I believe that that is the base case now at a PE of 20 times plus. If that doesn't happen, and I believe that the risk is that it won't happen because of this collection of leading indicators moving in the wrong direction, continuing to move in the wrong direction. Now, if they start to move in the right direction, I'll be the first one to report that to you here. But as you've noticed, if you've been following me here for the last year, these are virtually the same charts that I keep looking at, and I keep providing updates on them, and they keep moving in the wrong direction. So if they start to move in the right direction, then I will say that the chances of a soft landing have actually improved, and the market is not as risky as I thought it was. But currently, the direction of these trends are not good. And so I still continue to believe that analysts are going to mark down 2024 estimates. They haven't yet, but that's because we haven't seen the commentary by management in Q4 with regards to what's going to happen in 2024. Once we start to get that, once we get January and perhaps February updates on ISM manufacturing and services, I think that that's going to be enough to start to tilt analysts into marking these 2024 earnings down. When that happens, I believe that stocks are going to be very vulnerable because of where they're priced today at more than 20 times earnings. And again, that's 20 times very optimistic earnings expectations of about 13% growth. So we're not 20 times last year. We're 20 times this year, which expects 13% growth year over year. So again, this is a very rich multiple. So if that doesn't happen, there's going to be a substantial drawdown. And so that will be what we start to see this year. That's my bet. So again, my ideal capital allocation again for this year, should say 2024, is the same as what I said in 2023. 1-year treasuries, which pays 5%, and the Zacks earning certain portfolio. These are defensive companies with high quality characteristics with still strong growth. Earnings growth typically in the 6 to 9% per year ballpark. Again, that's very steady and consistent growth. And these are high quality companies. These are compounders that do well even during low growth or recessionary environments. So again, hope you found that helpful. These are the types of companies we own in the Zacks earning certain portfolio. Again, high quality, time tested business models that can withstand recessions, as you can see here. So again, thank you again for attending. If you have any questions, please do reach out to us at 1-866-794-6065, or you can shoot us an email at strategycall@zackspro.com. All right, thanks everyone. Take care. Talk to you soon. Bye.